Right, Sully's excuse today, Max. I think I had an email from him. Let me check. Yeah. Elliot here. Crampton excuse. Jay Leanne here. Nico. Val's here. Andrew here. Tom here. Olivia. Laurel here. Moberly here. Rosita here. Django here. And Alice here. All right. Let's continue with chapter 11, international money market. One of the terms we're going to use are things like euro dollar or euro currency. Technically speaking, it has nothing to do with Europe. The way those kinds of markets started had to do with Europe. Back in late 70s, there was a rule by Federal Reserve that limited how much banks could pay as interest to deposit holders in U.S. And if you may or may not know, especially in the second half of 1970s, inflation was pretty high in U.S. It went as high as 10% a year. And the limit, I think, was about 3%. Even though individuals didn't have many options, corporations didn't necessarily like that. So whenever they had free cash, they wanted to invest in an environment where they could earn more than that minimum. And obviously in situations like these, financial engineering becomes part of the game. What was created, banks created accounts that were domiciled outside of United States, in this case in Europe, but they were denominated in US dollars. And these accounts were called euro dollar accounts, and the deposits were called euro dollar deposits. Obviously, these were outside of the Federal Deposit Insurance, but if they were in a country where there was deposit insurance, those actually did apply. If a U.S. bank had a foreign subsidiary, they basically opened the accounts in there, or if they didn't, they did it through their correspondent banks. Either way, a U.S. resident, individual or corporation, could have accounts that yielded more than the statutory minimum. In fact, a lot of the money markets funds that started those days put their monies in euro dollar accounts. A money market account is basically a short-term mutual fund. It invests into securities that mature less than 90 days. Even as an individual, you could buy those money market funds and earn a higher return on your savings. So that's how kind of Euro market started. But these days, it refers to any account where accounts are domiciled in a country other than the currency, country of the currency of that account. So if you have an account in Japanese yen, but the account is not in Japan, that is considered a Euro-Yen account. So you could have a yen-denominated account in United States, that would be called a Euro-Yen account, even though it's not in Europe. That's kind of where the name started. And for short-term, these days, for short-term borrowings and loans, it's pretty much the most active market. And these operate pretty much at the interbank or the wholesale level. And you can't do transactions in euro currency market for $10,000. You can do it with your bank as a broker, but the banks themselves do it at multiples of $1 million or more. And typically there are reference rates. Of course, as of writing of this edition of the book, something called LIBOR actually did exist. LIBOR was short for London Interbank Offered Rate, and it was basically a reference rate. There was a LIBOR consortium in London, typically 20 to 25 largest banks that operate in the euro currency markets. Every day at noontime London noontime, they declare the rate at which they're willing to lend to other banks in the LIBOR consortium. And the average of those rates was considered the LIBOR rate. And if the same thing was done in Singapore, it was SIBOR, Tokyo TIBOR, and so on and so forth. But LIBOR does not exist anymore. There were some abuses. There actually was some collusion between the banks to keep the LIBOR too high or too low, depending upon their interests. And it used to be a reference for a lot of transactions, such as forwards, such as corporate loans. In US, for example, a lot of corporate loans are based on prime. Depending upon your credit worthiness, you get prime +1, prime -1. And euro currency markets, for USD especially, it was LIBOR plus a spread. Well, that doesn't exist anymore. There is actually a new one. Let me see. It's, I think, Bloomberg 3-month short-term bank yield. This is kind of a reference rate that's kept by Bloomberg. Bloomberg is one of the largest data providers in money markets, and people actually trade with each other through the Bloomberg terminals. So if I want to do a trade with another bank, all I have to do is go to my Bloomberg terminal, ask those banks for their quotations, and trade based on that. We even have a futures market on that. Let me see. Bloomberg 3-month futures. We used to have, let me see, CME. Let's go to markets, interest rates. Let me see, products. I don't know if they have started it yet, so let me look at it first. Actually, they haven't started that yet, but they have 3-month T-bill futures. we will talk about this a little bit later, but you could pretty much figure out the current T-bill, 3-month T-bill rates. These are the implied rates are 100 minus that price, and this is going to be basically 534, something like that. Okay, and we will come back to those a little bit later. I don't know if they have started the futures on those yet. BSBY futures. Let's look at it. Okay. Apparently they haven't started it yet, but it's going to be soon. But in the meantime, when we start talking about things like interest rate swaps, we would use these, but we could also use T-bill futures.